Next guest warns the Fed may disappoint Wall Street when that meeting happens in about 20 hours or so. Subadra Rajappa is the head of U.S. rates for Societe Generale. Subadra, great to have you with us. There does seem to be a lot of expectation built into at least 75 basis points through the end of the year. So is that where the disappointment may lie?
Yeah, it's not just the 75 basis points up to the end of the year. You're also looking at a total of 6 cuts by the end of next year. And the terminal Fed funds rate is actually lower. The market's pricing a lower rate than what the Fed has for its terminal Fed funds rate. So it's a pretty dramatic pace of cuts between now and the end of next year.
So what do you think we'll hear from Powell? He was surprisingly dovish the last time we heard from him. What are you expecting tomorrow?
He did surprise me at the Jackson Hole meeting because he's been kind of leaning towards no cuts, and then he kind of pivoted very quickly to cutting at the September meeting. I think that he might sound a bit dovish, but I don't think he's going to commit to an October rate cut. To me, it feels like it's still going to be meeting by meeting. I think you guys made some very, very interesting points. My concern is that if the Fed cuts rates aggressively, that you might actually see the long end yields rise. You know, inflation expectations start to rise. That's not a good thing. So I think that they're still going to be very measured, take it meeting by meeting.
What is your sense about, I mean, it feels to me, and maybe I'm looking at it differently, there's been this reacceleration of some of the inflation metrics that we look at. They're not trending in the right direction, let's put it that way. But the Fed made it clear that it's the employment picture they're focused on. I mean, if this inflation continues to sort of reaccelerate, it's a bit of a problem here. And I think that's, again, one of the reasons rates go higher from here.
Yeah, I mean, because if you look at the last couple of CPI prints, the gains have been kind of broad-based. It's not one category or the other. We thought that it's going to be mostly goods inflation. It's not. It's a lot of other categories that are not necessarily directly linked to tariffs. Yes, the feed-through from tariffs has been somewhat muted, but it's very possible that you see that starting to come down the pike in the numbers that are to come for the remainder of the year. So it's tough. I think that the Fed is going to be very, very measured, given the fact that they just don't know how inflation is going to pan out.
So in terms of your outlook for rates, where do they stand right now? And do you think that they could swing dramatically based on tomorrow's meeting? I mean, I'm just wondering how critical tomorrow you think is, given the setup going in.
So it's interesting that you'd ask that question, and we looked at what happened to 10-year yields on Fed meeting dates for the last several meetings. And what you notice is that 10-year yields tend to rally. But in July, you saw the opposite. You actually saw 10-year yields rise. So it's very possible that if we, given the fact that 10-year yields are close to 4%, which is the lower end of the recent range, the front end, the 2-year, is very effectively priced in for an aggressive policy path. If the Fed disappoints, if they don't sound as dovish as what the market expects, there's a chance that you could see yields rise.
Now, how do we view this from the stock market side, right? I think they are optimistic that we're going to see these rate cuts coming down. I mean, most definitively this week, but probably a couple more this year. But coming into this year, they were expecting, like 6 cuts that didn't happen. The markets have done really well. So I think the question is, let's say they don't cut as much as we're expecting. Is that going to be a bad thing for the markets, or are they set up well regardless?
So that's a tough one, because if you look at financial conditions, broadly speaking, not just equities, but if you look at the weakness of the dollar and credit spreads, we're really the market's looking at very, very easy financial conditions. So part of that easing of financial conditions is because the market is accounting for a very, very easy policy path. There's also the calculus on what's going to happen next year with the composition of the committee. Is the committee going to be much more dovish? All of that kind of factors into risky assets in general. So you could see an unwind of that if there's a sense that the Fed is not willing to act as aggressively as the market is pricing in.
And I know you're squarely focused on rates, but still, what does the move in the dollar, the move in gold, how does that educate your view on rates?
The dichotomy that you pointed out, Guy, about the strengthening of the rise in gold versus the dollar not doing as much is telling. So your flight to safety asset is now gold. It's not the dollar. It's not really any other asset in the U.S. Yes, you're seeing a run up in equities. A lot of that has to do with the dollar weakening. The question becomes what happens from here on, and gold seems to be that safe haven asset.